Hey everyone, welcome back to Corporate Decoder, the place where we dissect those boring corporate filings to find the hidden gems, or maybe just uncover a really long report that makes you ask what were they doing all that time. Today we're diving into a shareholder report from Advisors Series Trust, specifically for the Logan Capital Broad Innovative Growth ETF, covering the period ending the 31st of October 2025. If you appreciate getting straight insights from corporate documents, make sure you are subscribed. We also have a Discord community linked in the description below where we break down these reports further. So what's the big deal here? Essentially, this is a look under the hood of an investment fund, telling investors how their money has been managed, what the costs were, and what the fund actually owns. Think of it as a company's report card for the last 6 months. Let's talk money for a hypothetical $10,000 investment in the Logan Capital Broad Innovative Growth ETF. The costs for the last 6 months were about $50. That translates to 0.86% of the investment. For a fund aiming for growth, that's a pretty reasonable cost, not a huge chunk coming out of your potential gains. Now, for some key numbers from October 2025, the fund's net assets stood at a little over $92 million, making it a moderately sized fund. It held 58 different companies. The net advisory fee, which is what the fund managers earned, was about $272,000. The portfolio turnover was quite low at 3%. Think of turnover like how often a store rearranges its shelves. A low number means the fund managers are holding onto their investments for a while, which can be good for reducing trading costs and possibly for long-term growth strategies. The 30-day SEC yield was slightly negative at minus 0.13%. This basically means that based on recent income and expenses, the fund wasn't generating positive yield in a very short window. So, what exactly did this fund invest in? Looking at the top holdings, we see familiar names. Ploven Corporation, a company focused on mobile advertising and marketing, is the top holding. Then we have Cala Corporation, which makes equipment for chip manufacturing, and Broadcom Incorporated, a big player in semiconductor and infrastructure software solutions. Alphabet Incorporated, the parent company of Google, and Amphenol Corporation, which makes electrical connectors and cables, also feature prominently. Other big names like Netflix Incorporated, Apple Incorporated, Amazon.com Incorporated, MasterCard Incorporated, and Meta Platforms Incorporated round out the top 10. This tells us the fund is heavily invested in technology and consumer-focused companies leaning towards growth potential. And when we look at the sectors, it confirms that information technology makes up a large chunk at 37.7%. Consumer discretionary, which includes things people like to buy when they have extra money, is next at 16.3%. Communication services, which covers companies like social media and telecom, is at 16%. Industrials, financials, and healthcare also have significant portions. This sector breakdown really paints a picture of a growth-oriented, relatively modern portfolio. Now, let's zoom into the actual schedule of investments. This is where you see the nitty-gritty of what they own. For example, under capital goods, they have a position in Eaton Corporation plc, a power management company and fastener company, a distributor of industrial and construction supplies. Digging deeper into consumer discretionary distribution and retail, we see substantial holdings in Amazon.com Incorporated and Burlington Stores Incorporated. The semiconductors and semiconductor equipment sector is a big focus, with significant positions in Broadcom Incorporated and Cala Corporation. Notice that many of these aren't generating income directly, as noted by a non-income producing security. This further reinforces the fund's focus on capital appreciation rather than dividend income. They also hold money market funds, which are typically very safe, short-term investments, making up 2.1% of the fund. This statement shows us the fund's financial snapshot at a specific point in time. On the 31st of October 2025, the fund had $92.6 million in investments. They had some smaller amounts in dividends receivable and other assets totaling over $92.7 million in total assets. On the liability side, they had amounts payable to their advisor for administration, audit, printing, and other fees, which added up to about $93,000. Subtracting the liabilities from the assets gives us the net assets, which matched the figure we saw earlier. The net asset value per share was $63.92. This is where we see how the fund performed over the 6-month period. Investment income, mainly from dividends, was about $306,000. But then we look at expenses, which totaled over $362,000. This resulted in a net investment loss of about $55,000. However, the real story is in the realized and unrealized gains. The fund saw a net realized gain from investments of over $3.5 million. And the change in unrealized appreciation, meaning the market value of their holdings went up, was a whopping $19 million. This massive appreciation pushed the total net increase in net assets from operations to over $22.5 million. That is a fantastic jump and shows the power of their investment choices in a growing market. This table shows us the flow of money in and out of the fund. Over the 6 months ending the 31st of October 2025, the fund had a net increase in net assets from operations of over $22.5 million. But that is not all. They also saw a net increase from capital transactions, meaning more money came in from investors buying shares than went out from investors selling shares, adding another $1.1 million. This resulted in a total increase in net assets for the period of over $23.6 million. Looking at the previous year, the net increase was a much smaller $7.1 million. This shows significant acceleration in growth. Let's look at the per share data over several years. The net asset value per S-share started at $48.28 in 2025 and ended at $63.92 for this reporting period. The total return, which is the performance of the fund including price changes and reinvested dividends, was a very impressive 32.39% for the period ending the 31st of October 2025. Comparing this to previous years, we see some ups and downs, but this recent period is clearly a standout. The ratio of expenses to average net assets, which we touched on earlier, is 0.86%, and it has been pretty consistent, showing good cost management. The portfolio turnover rate at just 3% is remarkably low, confirming that the fund managers are not actively trading in and out of positions. Here we learn a bit about how this fund came to be. It's part of the Advisors Series Trust, and its investment objective is long-term capital appreciation. It started operations in August 2022. Interestingly, it was a conversion from a mutual fund to an exchange-traded fund or ETF in August 2022. The fund was essentially a shell at first designed to take over the assets and liabilities of the previous mutual fund. The investment advisor, Logan Capital Management, covered the initial costs of this reorganization. This section details how the fund calculates things like valuing its investments. They use fair value, which means they try to estimate the true market worth. They also comply with tax rules by distributing most of their income to shareholders, which means they don't need to set aside a lot for federal taxes. This is important for understanding how they determine the price of their investments, especially for stocks. They break it down into 3 levels. Level 1 is for prices from active markets, like stocks traded on major exchanges. Level 2 uses observable inputs like interest rates. Level 3 uses unobservable inputs, meaning they have to make more assumptions. As of the 31st of October, 2025, all of the fund's investments, which were stocks and money market funds, were valued using level 1 inputs. This means they were all actively traded on major exchanges, so their prices were readily available and reliable. This section spells out the fees. The investment advisor, Logan Capital Management, gets paid a monthly fee based on the fund's average net assets at an annual rate of 0.65%. For the 6 months reported, this amounted to over $272,000. There is also a promise from the advisor to cap the net annual operating expenses at 0.99%. This means if expenses get too high, the advisor will reimburse the fund. For this period, no expenses were waived or recouped, meaning the fund stayed within its expense limit. It also mentions that US Bancorp Fund Services acts as the fund's administrator and transfer agent, and US Bank NA is the custodian. Here we see the trading activity. For the 6 months ending the 31st of October 2025, the fund purchased about $2.1 million worth of securities and sold about $3.4 million worth. What's interesting is a footnote here about in-kind redemptions. When shareholders redeem shares, they sometimes get actual securities back instead of cash. This resulted in realized capital gains of over $3.5 million. These gains aren't taxed to the fund directly, but they are recognized. This part details the tax implications for shareholders. For the 6 months ending the 31st of October 2025, no distributions were made from long-term capital gains or ordinary income. Looking back to the year ending the 30th of April 2025, there was a distribution of about $43,500 from ordinary income. It also shows that as of the 30th of April 2025, the fund had significant unrealized appreciation on its investments and some tax loss carryforwards available to offset future gains. This is where they lay out the dangers of investing in the fund. They emphasize general market risk, meaning that global events like war or economic instability can impact the fund's value. There is also equity securities risk, where stock prices can be volatile. Sector emphasis risk is important because if a large part of the fund is in one sector, like information technology, which it is, then problems in that sector can hit the fund harder. They specifically call out information technology sector risk, noting intense competition, rapid product obsolescence and volatility. They also mention ETF risks like the concentration of authorized participants, which are the financial institutions that create and redeem ETF shares. There is also the risk that shares might trade at a price different from their net asset value, especially in volatile markets. Lastly, they highlight management risk, acknowledging that the fund is actively managed, and the advisor's strategies might not always work out as planned. They also mention large cap companies' risk and growth style investment risk, indicating that large companies might not grow as fast as smaller ones, and growth stocks can be more volatile. Then there are foreign securities risk and emerging markets risk, warning about the complexities and potential instability in international investments. Now, let's put on our Warren Buffett hat and look at the bigger picture. The Logan Capital Broad Innovative Growth ETF put in a really strong performance in the period ending October 2025, with a 32.39% return. This was largely driven by a massive increase in the value of its holdings, not by massive trading activity, as indicated by the very low portfolio turnover. The fund is heavily concentrated in the tech sector and large cap growth stocks, which explains the stellar returns in a potentially bullish market environment. However, this also means it carries significant risks. A downturn in the technology sector or a broader market correction could hit this fund hard, as highlighted in the principal risks section. The reliance on a few key names like Appleven Corporation, Clalla Corporation, and Broadcom Incorporated means any specific issues with these companies could significantly impact the fund. The negative SEC yield, while short-term, suggests that the current income generated from the portfolio is not covering its expenses, a common characteristic of growth. Focused funds where the priority is capital appreciation. The low expense ratio at 0.86% is a positive sign, showing good cost management by the advisory team, which is crucial for long-term investor returns. In conclusion, the Logan Capital Broad Innovative Growth ETF is a growth focused fund that delivered exceptional returns during this reporting period thanks to a strong performance in the technology sector and its core holdings. Investors should be aware that this performance comes with a high degree of sector, specific and market risk, and the fund is not designed for income generation. Fueled by innovation, particularly in tech. Alright, that is our breakdown of this Logan Capital Broad Innovative Growth ETF filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.